the Rodeo. I'm Bridget Pfister, CSU's Financial Compliance Manager in the Office of Sponsored Programs, and I'll be your guide for today's session. I was trying to think of an analogy that really captured the essence of managing cost transfers, and it was difficult. Wild goose chases? Doesn't quite capture it. Herding cats? Cliche. What really speaks to the reality of managing cost transfers at CSU? And then inspiration struck. A rodeo, but not just any rodeo. Our rodeo needs a little something extra. Why? Because cost transfers can be unpredictable. They just don't do what you expect them to do. Even when we think we have all the bases covered, special situations and extenuating circumstances add new caveats and additional justification requirements. You know what this rodeo needs to be entirely accurate? Squirrels. A squirrel rodeo. Here's a quick look at what we're going to talk about in this session. Squirrel wrangling, pole bending, bull riding, team roping, and finally, how to calm those squirrels down. We'll start with squirrel wrangling. What is a cost transfer? A cost transfer is an after-the-fact reallocation of expenses to or from a sponsored project. Basically, it's a reassignment of an expense from one account to another after the expense was initially recorded in the financial system. For our purposes today, these are our squirrels. So we tell these squirrels to move from one account to another, and what do? They start reopening effort certifications and sniffing around outside the budget period, and all sorts of things we never intended. Our squirrels almost never stay on task. So why do we want to enter them in a rodeo again? Because often it's necessary. Mistakes do happen, and we have to have a way to fix them after all. Our goal in this squirrel rodeo is to get our squirrels safely from point A to point B with as few unintended consequences as possible. So, why might we need to complete a cost transfer? The most frequent reason is to correct an error, particularly typos or transposition of digits and account numbers. Frequent errors also include charges made inadvertently to an account other than the one benefiting from the item or service, incorrect object codes, reallocation of salary costs to reflect actual effort expended, or we might need to move expenses to a new sponsored project account when setup's been delayed and we have not been able to get an advance account set up beforehand. From time to time, an unallowable cost may even be charged to a project, or a sponsor may disallow an expense we already made, and those have to be removed immediately as soon as they're identified. We often need cost transfers to correct or prevent overexpenditure as well. And sometimes we need to move costs between accounts for closely related work that's supported by more than one funding source. We'll talk more about multiple funding sources in just a few minutes. Cost transfers are permissible only when they are timely, reasonable, allocable, allowable, and consistently applied direct costs of the sponsored project as defined by institutional policy and the sponsor's policy. We can't just saddle up a squirrel any old time, no matter how much fun it is. We are trying to keep the squirrel wrangling to a minimum here. Typically, as we already discussed, the purpose of a cost transfer is to correct an error, which we hope are rare. If we have strong internal controls and adequate processes, then we should be catching errors and getting them corrected within the 90-day window. Late transfers do happen, but they should be rare and the result of extenuating circumstances. Remember that. We'll come back to it. The assumption is that we charge costs appropriately and correctly the first time, and that significant changes shouldn't be necessary if adequate policies, procedures, and internal controls exist at our institution. Thus, if an auditor sees a large number of cost transfers, particularly late ones, they may question our internal controls, leading to additional scrutiny and possible negative consequences later. So, you're thinking about entering your favorite squirrel in the rodeo? Here's when you might want to think twice about that. If your sponsored project is nearing its end date and there's still money left, it's not a valid reason to transfer expenses to the sponsored project in and of itself. The opposite's also true. If your sponsored project runs out of money, that is not an acceptable reason all by itself to move expenses to another sponsored project. You may have to move those expenses to a non-sponsored account if there are over expenditures. At no time should sponsored projects be used to park charges, which will subsequently be transferred elsewhere, including competing or non-competing continuations of the same project for which the notice of award or the new project hasn't been received. This can be a problem, particularly when we have a lag between the start date of the project and the account setup. The best thing to do in that situation is request an advance or at-risk account. Cost transfers are not a cost management strategy, and we can't use them to circumvent restrictions or for convenience. People often say, "Well, we can always move it later." But that's not always true. The best thing to do is make sure we're charging things correctly the first time, unless it's absolutely impossible, that is, there are extenuating circumstances, and keep the squirrels out of it. So, is every after-the-fact transaction considered a cost transfer? No. Sometimes we have other creatures masquerading as squirrels because this rodeo is so much fun. Sometimes transactions show up to the wrong event entirely.
Sir, this is a rodeo.
Sometimes we move costs or make changes that are not technically considered cost transfers. These are often processed as distribution of income and expense, or DIs, a document used at KFS to distribute the income or expense assets or liabilities from a holding account to one or more appropriate accounts when one account has incurred expenses or received income on behalf of the other. It can also be used to move income, expenses, assets, and liabilities to other subaccounts, object codes, or subobject codes. This is considered a transfer of cost and not a cost transfer. Examples might include leased vehicle mileage or cell phone use billed every month, animal care per diems, and research core facilities. There are other examples that might look like squirrels, but actually aren't.
Clearly, this is a bird.
The processing of these transactions is essentially the same as for cost transfers, but the nuance is important because transfers of cost don't require as much justification or receive as much scrutiny as actual cost transfers as defined in policy and regulation. They're not correcting any errors, and they aren't caused by extenuating circumstances. They're just a normal part of our job, not squirrels. They differ from our squirrels because they tend to do what they're supposed to do and not cause trouble. In the rodeo, pole bending is an event where riders on horseback weave through a line of poles, racing against the clock. Whoever can make it to the end in the shortest time wins. In our rodeo, we put our squirrels out there and expect them to navigate through all the rules without breaking any, and sometimes that goes about as well as you would expect. The regular allowability rules apply to cost transfers just as they do for regular expenses, with a few additional points. In the interest of time, I'm going to assume that everyone's familiar with the concepts of reasonableness, necessity, allocability, and consistency as outlined in the uniform guidance. Allowability is always the most important rule. The other one that's a big deal for cost transfers, though, is about timing. Some rodeo events have time limits, and our rodeo is no exception. Does anyone know how long a bull rider or a bronco rider has to stay in the saddle?
I think it's 8 seconds.
Can anyone guess what our time limit is in the squirrel rodeo?
It's 90 days.
As in, your squirrel has to finish their wild ride within 90 days of the original transaction. Fun fact. The 90-day rule actually originates with the NIH grants policy statement and has been adopted by most institutions and sponsors, so you won't find a direct reference for it in the uniform guidance. The implementation of this rule is different at every institution, and at CSU, our policy states that cost transfers must be processed as soon as possible after an error is discovered, but not later than 90 days after the original transaction. Of course, we all know that there are necessary exceptions, but as we discussed earlier, those should be fairly rare. Our policy also lays out the requirements for documentation and justification. But before we get into that, let's talk about the importance of these rules. Rules are made to be broken, right? We're rodeo squirrels after all.
No.
In award management, cost transfers are high-risk transactions, as they may be an indication of weakness in a university's internal controls and could indicate financial mismanagement. What's an internal control? Internal controls are the mechanisms, rules, and procedures an institution uses to ensure the integrity of financial information and to prevent fraud. An example of internal control could be the requirement for additional review and signature on certain types of transactions, like cost transfers, or separation of duties in accounting. During an audit, cost transfers are one of the main transactions that an auditor will scrutinize, and the more problems they identify, the harder they will look. Why? Well, excessive cost transfers, especially late ones, can indicate weak internal controls, which can indicate possible fraud, waste, and abuse. Additionally, auditors are generally unfamiliar with the institution and the projects, and audits often occur years after the fact. This is why it is so important to document everything meticulously.
Seriously, explain it like you're explaining it to your grandma.
Cost transfers are often questioned and/or disallowed because of missing documentation, inadequate justification, and an institution's failure to follow its own policies. Disallowed costs mean that the institution must return the money to the sponsor at minimum, but sometimes there are additional penalties applied depending on the situation. Some audit findings could even jeopardize future funding university-wide. As silly as it sounds, the outcome of the squirrel rodeo is actually kind of important. So how do we minimize the risk? Let's talk bull riding. Bull riding is probably the best known rodeo event. For our purposes, it's one of the most critical. For our brutally extended metaphor here, bull riding is about recognizing what could throw our squirrel into the stratosphere before our 8 seconds are up, and how to keep that squirrel in the saddle where he belongs. The following transactions present the greatest risks. These are the biggest red flags. Transfers between multiple sponsored project accounts. In our world, that's 5-3 accounts, especially if one of the accounts is in deficit. Why is that? Because it could appear that we're allocating expenses improperly based on something other than actual benefit to the project charged. Transfers occurring more than 90 days after the original transaction posted to an account. Even if we have a solid reason for a late transfer, it's still going to generate extra scrutiny. Transfers to a project at the end of the period of performance to use available budget, otherwise known as spending out the account. Again, this could call our financial management and allowability of costs into question. Inadequate explanation or justification for the cost transfer. Without the proper explanation and documentation, it is really easy for assumptions to be made about our reasons for a transfer. Our goal should be to make our justification so clear and our documentation so adequate, there's no need for further questions. Salary transfers that invalidate completed effort certifications. These are important because when effort is certified in eCert, we're agreeing that everything's correct and no changes are needed. When we invalidate certifications, particularly if this happens a lot, it points to internal control weaknesses.
Internal control weaknesses are bad, y'all.
Is there something that can help us mitigate all these risks? Why, yes, there is. Is it quick and easy? No. Your best tool for mitigating risk in the squirrel rodeo is, of course, to avoid it entirely. But if you know your squirrels are going to have to compete, your best tool for mitigating risk is an adequate justification. For any and all cost transfers, we need to include this basic information in our justifications. First off, what are we moving? We need to describe the cost being transferred, including why the receiving account was not originally charged. Then, explain why the charge needs to be moved and how and when the error happened. Where does it belong? Is it allowable? Explain why the charge is appropriate to the receiving account. This is where you need to include how the cost benefited the receiving project. This is easy to do for things like supplies and equipment, but a bit harder for effort. It isn't enough to say, this person worked on project A, but a brief explanation of the tasks the person was performing during the time period usually is. Finally, explain the timeline involved. When did the error happen? When did you realize it was incorrect? Every justification must include this information. In addition, non-salary transfers, which you'll know as GLTs, should also include documentation. That means receipts, relevant email conversations, and any other necessary attachments that support your justification. Sometimes a squirrel requires extra equipment to participate in the rodeo. You can't just send a squirrel out there with no boots on, for instance. How do you know when he needs gloves or something and when he doesn't? Well, it depends on what your squirrel's doing. If he's bull riding, he's going to need some gloves. If he's barrel racing, he probably doesn't. So what's your cost transfer doing? If your cost transfer involves splitting a cost between 2 or more sponsored accounts, then your justification must address the allocation method used to determine how much of the cost belongs to each project. The best practice, of course, would be to determine this allocation up front and avoid the cost transfer altogether, but if you haven't been able to do that, then you've got to clearly justify what you're doing. In this example, there's a couple things to point out. Dr. Investigator traveled to Clemson, South Carolina to attend a conference where she presented results and outcomes from projects A and Z as proposed. The presentation on Project A was 45 minutes and the presentation on Project Z was 15 minutes for a total presentation time of 1 hour. Thus, the Project A is supporting 25% of the cost of the trip and Project Z is supporting 75%. Both funding sources were acknowledged in the appropriate presentation. Where do we address benefit to both projects? Well, we've named both projects and we refer back to the project plans where we say as proposed, where we would have requested the funding to travel for dissemination of results. This clearly ties the cost of the travel to the proposed projects. We can easily go back to the documentation and verify it. Well, what about allocation method? Well, this is a really simple example, and not all allocations are as easy to nail down in quantifiable terms. We are dealing with squirrels after all. You could say that X number of test kits from a given order were used for one project and X number were used for another. You could keep a log of miles driven for one project versus another. You could discuss the number of hours it took someone to run testing for each project in the lab. But you cannot say because the PI said so, even if he did. The last thing to point out here is more of a good idea than a requirement. Both funding sources were acknowledged in the appropriate presentation. Why'd we put that in there? There have been a number of audit findings where universities have had to pay back sponsors for travel and publication costs because grant funding was not acknowledged properly, or there was no documentation that it was acknowledged, and thus auditors could not prove that it was actually related. But if we document everything explicitly every single time justification is needed, we can usually head off that particular issue. Perhaps one of the trickiest additional justification requirements we see is the one for late cost transfers. Remember earlier we said that a high volume of late cost transfers is a red flag for our auditors that we might have internal control problems? This is the riskiest type of cost transfer, so it should not happen frequently and requires more work to accomplish successfully. Per CSU policy, all cost transfers involving sponsored project accounts must be completed within 90 days of the original transaction. Exceptions can be allowed, but only in cases of extenuating circumstances, with additional justification explaining the extenuating circumstances and outlining corrective action taken to prevent future recurrences. So what exactly is an extenuating circumstance? Well, that's not exactly defined anywhere. Many institutions list the following as examples of acceptable extenuating circumstances for late cost transfers: late issuance of a grant award or full execution of a subaward agreement, failure of another department or service to take action, or a sponsor has explicitly disallowed a cost and we are required to move it off the account. According to a recent Incura webinar on the subject, some institutions only allow late cost transfers for those reasons. At CSU, we do have to document extenuating circumstances. So what does an extenuating circumstance look like? Many times, people will write something like short-staffed in the justification field and move on. However, short staffing may contribute to extenuating circumstances, but it isn't considered extenuating all by itself. Neither is a high volume workload, unfortunately, or fiscal year end, or the PI didn't tell me, or my squirrel's distracted and he keeps jumping off his horse. All of these things can make it difficult to get things done in a timely manner, and it can be very frustrating when you are insanely busy to explain in writing that you aren't able to get everything done. It can feel a bit punitive at times. But in order to get a late cost transfer approved, you have to make it very clear that something extraordinary happened that made it impossible to complete the task within the expected time frame. Okay, here's an example. This cost transfer is late because our department unexpectedly lost both staff members responsible for financial management and research administration in October of 2022. The department's 50 faculty have been without dedicated staff support for 9 months because of 2 failed searches. Staff from other departments and central offices have stepped in to manage critical tasks but did not have the capacity to maintain all normal procedures and timelines. A new staff member was hired on July 15th and interviews are ongoing for the other position. The new FO is working through the backlog as quickly as possible and expects to be able to clear up all of the outstanding issues by the end of August 2023. In our example here, we've explicitly stated that the situation was unexpected and we've quantified the situation. 2 positions, 2 failed searches, 50 faculty, 9 months, without sharing inappropriate details. The auditors don't need to know that the former FO got hit by a bus or something. They do need to know that there were extenuating circumstances and that we did everything we could to maintain good financial practices, and that we have taken steps to ensure that this situation is resolved. The only thing to keep in mind is that you can only use this type of justification for a limited time. This would work great for a late cost transfer being processed in July of 2023, for example. It would not be an acceptable reason for a late cost transfer in January of 2024. Also, remember that certain internal controls are already expected of us, such as regular financial reconciliation and review. If we state in our justifications repeatedly that we are starting regular meetings with our faculty to manage budgets as our way of ensuring that extenuating circumstances don't repeat themselves, a smart auditor will take note and begin to have a few questions. There can be many different things that rise to the level of extenuating circumstances, though. The key is in how you communicate those details. So let's say that we need to move some effort using a PPDA, and we have just passed an effort certification deadline in eCert. Our PI has certified their effort because that's what they're supposed to do, but let's say they didn't review it very closely and an error was discovered later requiring the PPDA. Any cost transfer involving effort for reporting periods that have already been certified must have additional justification. When we certify effort in eCert, we're basically saying that everything's correct as shown on the effort statement, so if we later reopen and change it, we're invalidating our earlier promise that it was right, effectively weakening our position overall and calling our internal controls into question. These situations are tricky to justify as well. We can't say,
My PI didn't read the fine print.
okay, here's our example. At the monthly budget meeting with the PI in May of 2023, it was determined that Dr. Colleague's effort was incorrectly allocated to Project Q during the month of March 2023. The FO had already completed pre-review in eCert before this meeting was held. Plans were made for the necessary adjustments to be made prior to effort certification, but because of a personal emergency, the FO was unable to submit the paperwork until June 1st. In the interim, the PI thought the changes had already been completed as planned when the eCert certification period for Q3 opened, and he certified the effort for Project Q in error. In this example, we have clearly explained what happened, again without disclosing anything personal or inappropriate. We've demonstrated that our internal controls, regular budget meetings, actually did work, but extenuating circumstances got in the way of our plan to fix the problem, and something very human and understandable happened. Well, that makes sense. So, let's practice dressing up our squirrels for their rodeo events. Come on, that sounds like way more fun than practicing justifications, doesn't it? For our first scenario, we've got a PPDA moving PI effort from a departmental account onto Project N at 5% effort for May through August. It was received by OSP on August 20th, 2023. Project N has a start date of 5/1/2023, and the account was set up on 8/15/2023. So the justification given is moving PI effort to correct account. How can we make this justification adequate? What do we need to include? Well, we might need to explain a little better what we're doing, how this is an allowable transfer, how it benefits the project, and the fact that it's been over 90 days. Here's one way we could improve on this justification. Dr. Investigator, PI on Project N, started work on the project at 5% effort on May 1st, 2023 as proposed and awarded. The project account was set up in KFS on August 15th, 2023. This transfer is late because the account was not available at the time the effort was taking place. It's being transferred to the proper account as soon as possible. So this justification is also pretty short and sweet, but it does cover the bases. It's assumed that the PI's effort benefits the project because, well, they're the PI. And if you're moving effort exactly as proposed, you shouldn't need a lot of details about what the specific tasks are. Referencing the proposal, which was approved for award by the sponsor, covers what we need here, as long as the numbers given match the proposal and award. Our transfer is also technically late in this scenario, and it's because the account was not set up for whatever reason. This works great when we're moving the effort relatively soon after the account setup, but it would not work well if more than 90 days have passed since the account became available and we still haven't moved the effort. If that happens, we'll need to document extenuating circumstances that prevented us from correcting the problem in a timely manner. Let's do another one. A GLT comes in on October 2nd, 2023, moving $5 of a $1,005 supply order that was made on September 15th, 2023 from a departmental account to Project T. Backup documentation is a PDF of an email from the PI that simply says charge Project T, and the justification given is Dr. Teachington got a $1,000 award and went over by $5, moving deficit to Project T. How can we make this justification adequate? What do we need to include? Well, we need to make it a little bit more clear what exactly we're doing here, why it's allowable, and how it benefits Project T. Well, here's one way we could make this one better. Dr. Teachington ordered splat reagents on September 15th, 2023, using funds he received as an award from the college to support his work on Project T. Splat reagents are necessary to complete tasks 2 and 4 on Project T and were originally budgeted for the grant, but the $1,000 in awarded funds were used for this purchase instead. The actual cost of the reagents exceeded the award by $5, so this GLT moves that cost to Project T, where the reagent was used. Here we've explained exactly what happened and why this purchase directly benefited Project T. We've also made it clear when the purchase was made so that presumably we can verify that the cost was within the period of performance. If we add a copy of the receipt for these reagents, we should be good to go with this one. Let's try one more. There's a PPDA that moves hourly wages from 2 months ago from Project G to Project R. The justification given is wrong time clock punch. How can we make this justification adequate? What do we need to include? Well, for one, we have to explain what we're actually doing, how it's allowable, and how the effort benefited the project. Sound familiar? Well, here's one way we could make this one better. Miss Hourly works on Project R caring for injured squirrels as part of the Project R initiative and has spent her effort on this project since January of 2023. In March of 2023, there was a time clock error resulting in a charge to Project G, which has a very similar account number. This error was discovered at the monthly budget meeting with the PI in May of 2023. We are moving Ms. Hourly's effort for March to Project R as her effort did not benefit Project G. Here we've demonstrated benefit to the project by explaining exactly what she does. I'm sure there are a lot of squirrels injured in this rodeo. This could be verified in the project plan because presumably it would say that someone has to take care of the injured squirrels, right? We've also given a clear timeline so it's easy to see what happened and why. We've mitigated the risk of moving effort between two different grant accounts by showing which account received the benefit and why the move's necessary. So now that we know how to identify a squirrel that needs to compete in the rodeo and how to outfit him properly for his event, we need to know what happens once he enters the arena. Let's talk about what OSP, that is, your Intrepid Financial Compliance Manager, does with your cost transfers once they're received. First, as you probably already know, there's 2 ways to process a cost transfer here at CSU. We use PPDAs for transfers involving salary and effort, and GLTs, and occasionally a DI here and there for other cost categories. There are materials and guidance on the web with instructions on how to complete the various forms, so I won't get into the details of that here in the interest of time, but I will include links at the end of this presentation in case you want to go take a look. We'll start with PPDAs, or Past Period Distribution Adjustments. PPDAs are received in OSP via a shared email inbox. Depending on where we are in the month and the fiscal year, the volume of PPDAs may be quite high. There are many things we review for, and each can result in the need for further research to determine what's going on, whether something's allowable, whether a transaction will post appropriately as written, and more. The goal is to process your PPDAs as quickly and painlessly as possible while still ensuring that we're compliant with all the rules we talked about earlier, and that we're covered in case of future audit. Please remember to be patient and refrain from sending your PPDA multiple times, as this actually makes everyone's review take longer. And here's a hot tip. We love DocuSign and Adobe Sign, especially if we have the option to add notes to the PDF. There are certain components that have to be included for any PPDA. If these things appear incorrect or are absent entirely, your processing is going to be delayed while I pepper you with questions. These are just a few of the things we look for when reviewing a PPDA. Some of them we've already discussed at length today, but there are a few here that bear mentioning. For example, if your award has already ended and a final invoice has already been submitted to the sponsor, it may not be possible or advisable to complete the transfer depending on the situation. Or, if the account you're moving the effort from is in deficit, or the receiving account is ending soon and has a high balance, and there's not justification present to document why the change actually belongs on the receiving account, the PPDA may be delayed until the necessary justification can be obtained. It's definitely against the rules to transfer costs that didn't directly benefit a project just to use up remaining funds, or to use funds from another grant to cover a deficit. We have to avoid even the appearance of doing that because an auditor will absolutely flag it and disallow it. But what about cost transfers that don't involve effort? GLTs are received by OSP in Kuali. Depending on where we are in the month and the fiscal year, the volume for these transactions can be quite high as well. There are many things we review for, and each can result in the need for further research to determine what's going on, just like with PPDAs. The goal is to process these as quickly as possible and ensure that we're compliant with all the rules, as we said before. There are certain components that have to be included for any GLT. If these things are incorrect or absent, then your processing is going to be delayed while I, again, pepper you with questions. Also, because of system limitations in Koali, the late certification questions always have to be answered, even when your GLT isn't actually late. This is because we don't have the option in the system to leave the questions off, so it's all or nothing. If you're submitting your GLT immediately after the original transaction, it's okay to put not applicable or this is not late or something similar in answer to those last two questions. For my particularly innovative squirrel wranglers, if you put this is not late on a GLT that actually is older than 90 days, rest assured that it will be noticed and we will require the necessary justification. Like good auditors, we trust but verify. Speaking of verification, here's a hot tip. GLT reviews go much faster when original receipts are actually attached to the GLT record. The more research we have to do, the longer everyone's process takes. Once again, there are a number of questions we look at when reviewing your GLTs. These probably look familiar since we just saw most of them in the discussion of PPDA review. For all cost transfers, if we see problems on any of these points, we'll need to contact you to resolve the issue before we can approve. In most cases, we can resolve issues and move forward, but sometimes there are problems that can't be resolved. In other words, our squirrels get thrown off whatever livestock they're trying to ride and they just have to leave the arena. Oh no, your squirrel joins the rodeo and is disqualified? Well, these are things that are going to stop your squirrels in their tracks. Occasionally, we see squirrels that try to move cost onto a grant that are not allowed either under the uniform guidance altogether or by the specific sponsor of the receiving account. In those situations, the cost transfer must be disapproved. We can't allow costs incurred outside the grant's project period to be moved onto the grant. Why? Because A, we can't demonstrate that such costs benefited the project in question, and B, if we did move these and they were discovered later at audit, they'd be disallowed and could cause more serious consequences. The only exception to this is when we have costs that occur prior to the official start date of the project. Under the FDP expanded authorities, some sponsors will allow pre-award costs up to 90 days before the project begins. This is great, but not all sponsors allow it, and some only allow it with prior approval. So we need to make sure of that before we put in a cost transfer. If the account we're moving cost to is in deficit or does not have enough money in it to cover the cost being moved, we can't approve the transfer until there's sufficient funds, or at minimum, until we can document that additional money is on its way. This is because we don't want to create more deficits, which will then create the need for additional cost transfers, which causes additional risk, which causes, well, you get the picture.
There are way too many squirrels in here.
If your squirrel arrives inebriated and half-dressed, if your justification and supporting documentation are inadequate or missing, as we've already discussed, at minimum, your transaction will be delayed while we ask for the required information. There are times where it's not possible to adequately justify a transfer, and in those cases, we can't approve and allow it to move forward. If your transfer requires the reopening of an effort certification that's already been reopened and recertified in the past, it's likely that your transfer will be disapproved. There are rare cases where this is appropriate, if a sponsor requires us to remove a cost after an audit finding, for example, but most of the time, the risk of multiple recertifications outweighs any benefits of moving the cost. And it goes without saying that transfers that do reopen previously recertified records should be moving effort off the grant and onto a non-sponsored account. We've talked about a lot of ways to manage our squirrels and get them through the rodeo safely and successfully, but of course the best thing to do is to choose only the very best squirrels to compete in the first place, or ideally, none at all. How do we do that? The best way to minimize or avoid participating in the squirrel rodeo is careful financial management of each account. Whenever your PI receives an award, work with them to develop a spending plan for the project and review it monthly. Reconcile your accounts on a regular basis and monitor expenses closely. Evaluate how quickly or slowly your PI is spending throughout the project and ask questions if things don't appear to be progressing. Set up salaries on the proper accounts ahead of time when you can, and make sure your PI is aware of the eCert certification periods and how they could impact any transfers you need to make. When errors are discovered, fix them as soon as possible so that you don't have to worry about that 90-day window and additional justification. Always document allowability and benefit to the project when assigning costs to a sponsored project, either upfront or when doing a transfer. Make sure it's obvious why the cost is necessary and that it belongs where it's being charged. Doing this will often prevent errors from occurring in the first place. If your award is hung up in negotiation or a sponsor is taking a long time to send the official award document, request an advanced spending account to minimize the need for cost transfers later. All of these strategies will keep your participation in the Squirrel Rodeo to a minimum and help you ensure the success of your projects. I hope you've enjoyed today's session in the Squirrel Rodeo. Thanks for coming. As promised, here are some resources that you can use to learn more.